What looks like small price swings, minor sell-offs, or chatter about market corrections is actually a signal of pressure building beneath the surface. Not panic yet, just tension. The kind of tension that only shows up when a market is being stretched past what it has historically handled. On paper, everything still seems fine. Charts move, brokers trade, prices tick up and down. But when the real demand hits physical silver, friction appears. Shortages, delays, confusion dressed up as normal market behavior. That's not coincidence. That's a system under strain, and Michael Oliver points out this isn't going to fade quietly. Oliver emphasizes that this is bigger than speculation or sentiment. This is silver breaking out of decades-long patterns, while gold quietly continues its march higher. Every attempt to control prices on paper only increases the gap between what's on a screen and what exists in reality. Physical demand is accelerating, unseen by most, and when the market catches up, it won't be gradual. This is why this moment is critical. These aren't signals you see after the fact. They appear before the surge, before people realize access to metal or liquidity isn't guaranteed. When that understanding spreads, silver and gold won't move slowly. They'll jump. By the time everyone notices, the chance to get in at current levels will already have passed. In this video, we'll break down the forces reshaping the gold and silver markets, from supply chain pressure to institutional behavior, and why these dynamics suggest the next phase may unfold faster and less predictably than most investors are prepared for. If you value analysis that looks beyond price and into structure, be sure to like the video, subscribe to the channel, and stay with us for the full discussion.
Gold's reality is this. While silver's been capped in this half a century silly range compared to any other asset on the planet practically, gold hasn't. Gold made a high in 1980, then made another in 2011. They were each eightfold gains from bear low to bull high, higher bear low, next bull high, eightfold gains from bear low to high. Okay. Our bear low is $1,050 in December 2015. Okay, we're only a little bit more than fourfold right now. If we went to eightfold and quote, did it again, in other words, the norm, okay, have another normal gold bull market, like the two we've just had in the past 50 years, you'd be $8,500 gold just to do the norm. And yet we're in a different world now, like the T-bonds. They're not, they're in crisis mode. They weren't back in those particular times. So just to go to 8,500, wow, you think that's crazy. No, it's not. It's done it twice before. And yet silver is just now taken out its 1980 high and its 2011 high. It's got a lot of catching up to do. And also on that percentage basis, ounce of silver to ounce of gold, it's off the page cheap. And what if silver, again, not only took out its 50-year highs on price and went nuts and went to a new reality, why shouldn't those spreads go up and challenge or maybe take out those highs? 6.5%, 1980, 3.1%, 2011, we're at 2%. And if gold is $8,000, only $8,000, a normal eightfold move, and silver goes to 3% or goes to 6.5%, it's off the page, So that's what we're looking at, and it's not going to be incremental arm wrestling. It's going to be sudden. Dollar is already broken in our estimate. It broke in April last year March of last year at a price of 104.21, closing price that month. We put out a major sell signal, said the dollar is now in a bear. Price chart wasn't. Price chart has been laying for the last, couple quarters on an uptrend that anybody with a crayon and a ruler could go back to like 2008 on the dollar index. Remember, the dollar index doesn't measure the real buying power of the dollar. It measures it versus two other fiats, especially yen and the euro. Okay, euro and yen in that order. They're 70% of the dollar index. So it's one piece of crap versus a couple of others. But so it's not its real buying power, but versus them, it's broken a momentum uptrend. When I use a 3-year average oscillator or a 10-year average, there's a momentum trend line that while price is holding that line, or rather put it this way, laying on the line for a couple of quarters now. No rally off of that price chart line, just laying there like it's dead. But momentum already broke that comparable structure. Price will break it too. So if you see the dollar slip from its now 98 something, So it's only about 6 points below where we sit sell it. Uh, and you see it get down and much below 95, let's say. Even the price guys are going to say, "Oh gosh, it didn't hold." And I think you'll assault the old lows at 70, which we saw, a couple decades ago.
Wow.
But that's just, again, that's sort of meaningless because it's like, who cares? It's one piece of paper versus another. They're both degenerating in real value year by year, decade by decade. It's real value uh, is, I've said this probably in an interview before. Your granddad built a house for 4,500. Your dad built one for 45,000. And now if you want to build a median price, it's 450,000. There, degeneration of the currency. Oh, I think you can see 50% or more, but I think it's going to be more layered than a collapse. We think that since 2025, early in the year, February, I think it made its high last year, so a year ago almost. It was just below 6,200 on the S&P. Right now we're trading what? 67 something? Yeah. So we're up, 10% or so above that high peak of last year. I think it's been a topping process since then. Our momentum work, forget the price chart. Price chart made a high, had a sell-off low, then came back and took out the high. So it's been zigzagged either side of last year's price high, down, then up, now headed back down again. We think that's a topping process on price, while momentum has not made new highs. When price came up and made new highs this year, momentum said, I'm not even near the 2025 high. And there's certain levels on price that if you get to on a monthly close during this year, you'll start breaking some of the structures on annual momentum and on quarterly momentum, which are two long-term momentum metrics we look at. And they're not far below where you are right now, but I want a monthly close there. But even when you break those, I don't think it's necessarily anything that collapses. Yeah, sure, you might shed 10 or 20%, but we do that quite often in the stock market. I'm talking about something a la that October event in 2008 where you dropped like 35% in a couple of weeks. I don't think that's on the horizon until you get much further down than we are now. I don't specify the number. We do that in our reports, but it's not near where we are now. So we could get some sell-off now that could hurt and cause people to lose all the money they made last year, for example. So a whole year wiped out in the first part of 2026, but not precipitous, the kind that generates the irrational selling of silver and gold miners because the stock market went down. And by the way, those people need to wake up. To a very sharp day in the stock market today, and yet they're up 3 and 4%. No. But I don't think that kind of stock market collapse is immediate. I think it could happen later in the year. So that market, I think, is not a place to be. I think commodities are in general, commodity stocks, including oil, by the way.
One thing is clear from Michael Oliver's perspective. The tension in the bond market is not subtle. Yields on long-term treasuries are pinned at ceilings. Debt rollovers loom, and central banks have limited control. This isn't a slow grind. It's pressure that can erupt quickly, forcing rapid interventions and unexpected market reactions. Oliver points out that silver has been trapped far too long in a half-century range. Even as gold repeatedly set new highs and monetary conditions shifted dramatically. That gap between the metals wasn't sustainable, and the market is now correcting decades of distortion. Silver is moving not just in price, but in its relative value to gold, and historically, that relationship has signaled the most aggressive surges. What makes this setup so compelling is the combination of factors: strained bonds, central bank reactions, and silver's relative undervaluation. Oliver's analysis suggests that much of the move could come fast, in what he calls a thunderbolt adjustment, where the market suddenly recalibrates to reflect real-world conditions rather than paper-based constraints. Investors focused solely on price charts risk missing the deeper dynamic, the spread between silver and gold, which historically triggers the largest and fastest moves. When this relationship breaks out, the upside can be dramatic, with miners and bullion both positioned to benefit from the shift.
The key to watch, and we've been saying this for months, when we're focused on silver and gold, the key level to watch is the bond market. Because we know this time around, not like 2000, 2002, which is dot-com bubble. Okay, fine. Simple explain, a overdone sector. Or mortgages, 2007 through 9, this family, that family, a lot of mortgages. Okay. This time it's government bonds. And they're the Titanics of the world. Ours, the Japanese bonds, UK, you name it. They're all in dire straits. And we know that, and it's not because of just what's happening now. It's been what's building up and building up and building up. Okay. And now suddenly, because of the events of the tariff versus, the war between us and NATO and Europe and so forth, uh, they want to dump everything. The Europeans sell all those bonds, et cetera. Fine. Okay, good. They should anyway. What the heck? Uh, but T-bonds, technically, we've been assessing them continually. T-bond futures is what we look at. They're 30-year bond futures, been around for decades. Okay. That does not influenced by the Fed's short-term rate cuts. In fact, they've cut rates, for a period of time here, and the T-bond yields are nailed to the ceiling, high, prices low. And if you slip those prices down much below where they are now, the T-bond futures price, 2, 3 points below where they're trading now. They reached into the 113s today. Okay, I'll explain that in a minute. You could precipitate a panic where you don't just get a price drop, but you get a real quick couple day, oh my, crash type fear. Okay. You can't have that in the bond market. It's bigger than this. Its stock market doesn't compare to the T-bond market. And it's not just us, it's Japan. We know that. T-bonds collapsed from 2020 to 2022. October 2022, they made a low. They dropped from 180.90 on the T-bond price down to 117, much of that occurring in the year 2022. Okay. Since October 2022, you can draw a line sideways on the price chart or across the yields on a high level. It's gone dead, staying at those levels, either side of that 117 price level. Right now, we're actually below it. There have been 3 bond rally attempts in that last couple of years, 3 years, where there have been rally efforts to try to get it up off the floor, drop the yields, and they've not taken hold. None of the rallies have worked. None of the dips in yield have sustained. They've gone right back up. Okay. If you slip down now, much below today's low by a couple points, and we won't get more specific, we do with our subscribers, you could precipitate what we call at least a mini panic. And I know that the Fed will intervene because already in November, Williams, the head of the New York Fed, announced or in a press conference stated that the Fed was going to, quote, start buying bonds. Why? He said, oh, just because liquidity in the market needed more liquidity. Okay. Didn't say anything about how bad they were anyway, but liquidity. Okay, fine. They've been buying bonds since November. It's evidence you could see. And bonds have dropped from 117, 116, and for the last couple months, in the narrowest price range in T-bond futures history, like they're dead. They can't rally. They also don't go down. Now, suddenly today punched out that recent low in just below 115. We even got below 113 today. Now, we've got some trigger levels that require a few more points. But if you do that, you could get this thing to start to puke. You cannot have that kind of event. Everything else is meaningless if T-bonds start to go down. People go hands in the air. Okay. And same with the central bank. Well, what's the prime beneficiary of the central banks going berserk, printing money, expanding money supplies, playing games? Gold, real money. Silver, real money. The long end they can't control. Yeah. The issue is, though, the speed of this event. If we're entering like what Japan just experienced last night in their T-bonds, their bond market, which has been going up in yields and yields ongoing, but now it's spiking. We're starting to if we start to do the same thing, that's like a nuclear event, especially for markets. And we know the central bank will go as berserk as they possibly can. They know what all kinds of tools they've had in the past. They'll use them all. They'll invent new ones. I don't know what they're going to do. But they will have to panic because it's too big not to intervene. The question then is our assessment of silver in particular. We think gold and silver are going up a lot more this year, a lot more. Okay, multiples more. But silver is going to beat the pants off of gold. Silver is very depressed to gold. We all know that. It's been depressed for a long time, so that hasn't worked. But the technicals that say it shifted into an outperform versus gold occurred in November at the close. By our metrics, we said, okay, game is on. Silver's going to launch versus gold. It's now up to 2% of the price of gold. Early this year, last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. And if you go back in history and look at where was an ounce of silver versus an ounce of gold as a percent, let's say the 1980 bull market peak when we hit $50, that old range, okay, it was at 6.5%. 6.5. We're at 2. Okay. And in 2011 peak, when we hit 50 the second time, it was over 3%. We're at 2. Our technicals show us that that spread relationship is broken out, and we're likely, think about this, silver's been in a 50-year, half a century dull range, suppressed, whatever. Gold hasn't been. Gold blows the heck out of every prior bull high. Copper's not where it was back in the 1970s, 80s, 90s, 2000. It's 4 times that price. Silver, for some reason, has been contained. Whether that's manipulation or a combination of events, it made a mistake. And whenever markets make a mistake, they tend to compensate for it and quite often overcompensate in a tantrum. This has happened many times in markets. It's not usual, but it happens. Copper did it in 2005-06. Lead did it in 2007. We quadrupled in a couple quarters to a new reality. If silver does that, our projection is you could see silver this year $300 to $500 an ounce. Okay, now, much of that should occur within the first couple quarters of that spread breakout, meaning much of it should occur by middle of this year in a thunderbolt tantrum move. This event that's going on now with T-bonds could help speed that up because it panics the central bank. And if you're an investor and you look at the horizon, what do you got? Do you want to buy the stock market? The world's selling it now. You want to buy the T-bonds? What's left? What's doing well? Well, what your buddy down the street told you 6 months ago that he did, and you didn't do it. You buy silver. Instead, all we're hearing on the internet is let's short it, it's over. I think this surge that we get in the immediate horizon, if those T-bonds slip a bit more, could take silver well past 100, which might be sort of a normal guy's expectation of where the doubling of the old $50 high, And you get a midpoint stumble in this 6-month explosion, which we do expect to get a midpoint fake out stumble. Where's it going to be? Is it going to be at a logical level, or at some level it just turns people's heads, like $130 or something? These events that are now going on with T-bonds could precipitate that. And if they do, watch out for the Supreme Court. Because if those guys come in and say, hey, we're going to step into history here, we're not going to let you do that, or at least try not to, and create doubt about whether he can do it, in which case, panic's over, right? You could get a lot of volatility at that point. Anyway, long silver over gold.
The first thing to understand is that gold and silver are not moving in isolation. They are reacting to pressures that have been quietly building for years. Central banks are quietly buying. Global debt and interest rate shifts are creating tension, and the dollar is under pressure. On paper, markets may seem calm, but underneath, the forces are aligning for a potentially sharp and unpredictable move in precious metals. For gold, analysts are looking at a potential rise toward $4,600 per troy ounce by the end of the year. While price action may not be linear, the combination of economic uncertainty, geopolitical risk, and ongoing central bank accumulation suggests that any pullbacks are likely to be temporary. Deep drops below $4,000 appear unlikely, making current levels a strategic point for investors seeking long-term gains. Silver is showing an even more compelling story. Long undervalued relative to gold, it is now positioned to correct decades of suppressed pricing. Historical trends show that once silver begins outperforming gold on a relative basis, gains can be sudden and extreme. This year, silver could break through old ceilings, potentially doubling or more relative to gold, creating a surge in both bullion and mining stocks. The connection between bond market tensions, central bank interventions, and metals' relative valuations means we are likely to see sudden bursts rather than gradual trends. Those who focus solely on spot prices may miss the deeper shifts driving the market. It's the spreads, the technical breakouts, and the structural imbalances that often dictate the biggest moves. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.